Hello and welcome to NDTV Profit. You're watching Know Your Company. Today on KYC, we are looking at Lodha Developers. The reason why we've picked a Lodha Developers is on the back of Q1 earnings, a good set of numbers that the company has reported on a year-on-year basis, but a sequential decline that has come in here. I'm Hiral Dadia and with me is Mahima Vachrajani. But let's quickly address why Lodha Developers today. Firstly, what has led to the sequential decline that we've seen in terms of where earnings are concerned? On point number two, the other question that we will ask the management is about the India-Pakistan war. The management has indicated that this did lead to around 2 weeks of downtick in terms of execution. So how much is the impact in terms of quantifying it if you have to look at the financials? On number three, you're talking about the first quarter FY26 pre-sales. That number is below the guidance. So what does this mean? Will it mean that they will not be able to meet that FY26 guidance as a whole or not? On number four, the auditors have flagged non-compliance for NCDs. Now, what is the impact? Because here, you're talking about the security deposit that they have to leave for the bondholders or the debenture holders. That is not in line with the security deed. So what happens then? And the competition that they are seeing in the Mumbai metropolitan region, you have a lot of other developers that are coming in. The strategy, what they're going to look at in terms of Bangalore and Pune also is going to be crucial. And very lastly, FY30 guidance, what are going to be the key growth levers that you should be watching out for them to meet this guidance? So that's what we are looking at in terms of where FY30 goes. But let's shift focus in terms of the key parameters that you should be looking at. Firstly, before the parameters, we look at about the company in terms of what the company is doing in trade. Firstly, as we know, Lodha established in 1980s. It's one of India's leading real estate developer. They have strong focus, if you talk about residential projects, nearly 4 decades of experience is what you're looking at. They cater mainly to luxury as well as premium, and they've rebranded itself from Macrotech Developers to Lodha Developers. And this is after the stew, that Lodha Developers had with House of Abhinandan Lodha. Moving on, apart from this, if you talk about the other details, the markets that they operate in, Mumbai, around 10% market share is what they had in FY24. Their flagship, and this is their flagship and dominant market, and the largest contributor to the pre-sales. If you talk about Pune as well, that's the second market that they operate in, third largest in Pune, and they're growing fast over there. Over 11% of their gross development value is planned from the Pune market. Moving on, when you talk about Bangalore as well, they've entered Bangalore in November 2023, and recently they moved from pilot to growth phase in the Bangalore market. They're around 4% of their FY25 pre-sales comes in from Bangalore, and they're aiming for 15% market share in the medium term from the Bangalore market. So hence we've said that strategy with Pune and Bangalore is going to be crucial for Lodha Developers. Very quickly, if you talk about their split, in terms of Pune 14%, Bangalore is 7%, and largest 70% comes in from the Mumbai metropolitan region so far, Mahima.
Right, so it's interesting because almost 75, so a lot of concentration in the MMR, which is actually heating up in terms of competition. So that's an interesting question to ask the management as to how competition is shaping up. But in terms of the key offerings, of course, residential real estate is their core business. Luxury premium is something that they concentrate on only in luxury and premium housing. In terms of the overall digital infrastructure parks that they have, that's industrial, warehousing, logistics and data centers, that uses the annuity income model. So that's one of the things that they have, in their basket. There's also commercial real estate, which is very small as compared to where the residential real estate stands, but still, select office and retail developments, mainly as a part of mixed use of projects, is what comes under them. In terms of the overall facilities that are being managed by them right now, they're managing over 70,000 plus residential units. Recently also launched the Bellevue, a digital platform for integration of residential services as well. So that's an interesting one, and we have to ask the management as to how this is faring for them. There's also in terms of the product wise mix in terms of Lodha Developers as of FY25, the mix in terms of the revenue. around 89% of the total chunk of revenue comes from property development. Then there is sale of land and development rights, which is 9.3%, and around 3.5% annuity and lease income, which generally comes from the digital infrastructure parks. Now, in terms of the overall key projects that the company is looking at right now, there's the Palava project, which is India's largest city-scale greenfield development project, and this is located on the outskirts of Mumbai. So again, one big project that they have in the MMR region. Then this is designed for walkability, sustainability, as well as an emerging data center hub. This is something that they're aiming along with the overall project. In terms of the Upper Thane region, that's the another Upper Thane project, which is another big project on their cards, which is a large township development positioned for long-term and high-margin growth. So this is something that is going to be a margin accretive project for them. And then there is one Lodha Palace, which is 100% renewable powered, grade A commercial complex, and it's one of the company's headquarters as well. So this is going to be a very interesting project to watch out for. This is everything that one needs to know about Lodha Developers so far.
Absolutely, and I think the key from here on is going to be the rating parameters that we are going to discuss right now for knowing Lodha. Firstly, you have the income statement check, operational matrix, balance sheet, cash flow. These are the top four. Moving on, we will be talking about their shareholding, their street credentials, the street coverage, as well as the outlook that the company has from here on. But let's start with the first one, which is the income statement. If you look at the revenue, EBITDA, margins, and net profit, that's the crucial aspect wherein you've seen a growth of around 14%. That's the 3-year CAGR. EBITDA has seen a growth of around 15%. Again, that's the 3-year compounded growth. Margins have been in that range of 35 to 36%. So that there you've seen some bit of stability that has come in. And the profit has grown faster than your revenue, which has seen a growth for almost around 30% on a 3-year compounded basis. So a strong number coming in on that front. Your margin trajectory, if you talk about it, that range again has been between 31.4%, which they achieved in FY23, to a high of around 36.1%, which they achieved in FY25. The first quarter of FY26, if you talk about that, the margin has been in that 28 to 29%. Now, whether they are able to cover up this gap in the next 3 quarters is the question that we need to check with the management, because if they are not able to do that, there's a potential for them to miss that 31 to 36% kind of a band trajectory as well. Moving on, if you see in terms of what has not worked, sequentially they've seen a degrowth in terms of revenue, EBITDA, margins, and profitability. And I think that's what the street is reacting negatively to, because year-on-year basis, it's a strong number that the company has reported. Revenues have seen a growth of around 20 to 22%. Margins have expanded and come in at around 28.2%. And your net profits have seen a jump of almost 42%. So year-on-year, good growth. Sequentially, there has been a downtick, but I think the management will be here to answer that question. But overall, a thumbs up.
Right. So, the same has happened with key operational metrics as well. And that is because that is one of the reasons as to why the revenue is also impacted in terms of where the year-on-year number stands. The guidance was to achieve a growth of 20% in terms of pre-sales for FY26 as a whole. But this quarter, the overall pre-sales growth is around 10%. So the key question would be whether they'll be able to achieve the overall 20% guidance by FY26 or not. In terms of the yearly change in terms of how operational metrics have fared, pre-sales has seen a good growth of 21%. Collections also a good growth of 29%. Collections in terms of quarterly performance, the YY growth has been around 7%. So slightly lower in terms of where the quarterly performance stands, but overall a good growth when it comes to over yearly performance as compared to FY24 where FY25 stands. So because the overall yearly performance has been good, and generally real estate companies need to be seen from a yearly basis, we've given it a thumbs up when it comes to the key operational metrics.
Right, so that's with the operational matrix, but let's quickly look at the balance sheet. It's very interesting to see how the balance sheet of this developer is panning out, because you've seen an expansion in terms of the equity. From a 480 crores, it's been stable over the last 2 years, that's FY24 and 25, in that 1,000 crore range. Other equity has also seen a sharp improvement. The book value has also nearly seen a growth of around 80% if you have to compare from FY23 to FY25. The borrowings, what's interesting, has nearly reduced from 9,050 odd crores in FY23. It's come down to almost 7,080 crores in FY25. So that's one of the positives, because of which, if you see their debt to equity as well, that's been in the pretty manageable range what the company has guided for. The only thing which is dwindling is in terms of the cash and bank balance. If you have to compare to FY24, their FY25 cash and bank has come down to 2,320 odd crores versus a 2,950 odd crores. But if you have to compare it to FY23, it has improved. So on an overall basis, the balance sheet is still looking strong, and that's the reason a thumbs up on this one.
Right. Moving on to the cash flow statement, it's an interesting one, because, I mean, if you see the overall picture of operations from cash flow, that has been on a declining trend from a 2,750 crores in FY23 to a 1,500 odd crores in FY25. So that's been on a declining trend. Overall, when we take a look at the percentage of operating cash flow to EBITDA as well, that's been on a declining trend and almost come down from 93 odd percent to 32 odd percent. So that's almost 1/3 of what it was doing in FY23. And because of this reason overall, plus net cash flow has gone to negative, but that's also because they've repaid borrowings in FY25, and that's the reason as to why the net cash flow position in FY25 has gone into that negative territory. But overall, considering the declining operating cash flows plus the cash flow to EBITDA, operating cash flow to EBITDA ratio declining quite sharply, we've given it a thumbs down when it comes to the cash flow statement.
So that's the cash flow. Let's look at the shareholding. If you see in terms of where the shareholding pattern goes, the promoters have reduced stake from 75% to 71.9%. FIs, though, have been increasing stake from a 19% to a 24.6% in the last 3 years. What's interesting is you have your DIIs, which is your mutual funds, have been reducing stake to an extent, not a major one, but from a 3.7% to a 2.4%. The only concern is the public free float. It's pretty small, 2.3%. It's come down to around 1% right now. So the liquidity with regards to Lodha is not very strong, but it does not really give you a bad picture. Taking into consideration your FIs have been increasing as well. Promoters are not selling to that extent, and that's the reason a pretty neutral looking shareholding pattern is what we're looking at right now.
Right. So in terms of street cred, the stock has not done much in the past 1 odd year. It's down around 9 or to 10 odd percent in the past 1 year, and 5 years also. It's not been that sort of multi-bagger that we've seen in a lot of counters. It's up around it's given returns of around 366 odd percent. So we're taking a conservative approach here and giving it a thumbs down when it comes to street cred.
So that's the street credentials that you're looking at. And very lastly, if you see in terms of street credentials as well, the coverage, I mean, you have 13 buy ratings, 4 hold and just 1 sell. If you see the upside, it's almost 21% on a consensus basis from the current market price, so a strong number coming in. So a pretty neutral coverage that we're picking up there.
Right, so strong outlook, that's the last parameter, because companies remained on track. FY26 pre-sales guidance of around 21,000 odd crores. It's added 5 new projects with a gross development value of 22,700 odd crores. Has achieved 90% of FY26 guidance already of 25,000 rupees, 25,000 crores. Expects collections to be stronger in second half of FY25 is something that the management has guided. The new project additions to reach 250 by FY26 is something that the management has guided for. And an interesting one that I observed in their presentation was the 2020 action plan by 2030. That's focused to deliver 20% pre-sales CAGR, as well as to deliver 20% ROE with net debt ceiling of around 0.5 debt to equity is something that the management has guided for. So this is the overall outlook that the management has given so far.
Absolutely. So now let's look at the final performance rating that NDTV Profit has given a Lodha. Income statement, operational matrix, balance sheet, a thumbs up. Cash flow, as Mahima explained, is a thumbs down. Shareholding street coverage is an absolute neutral. So your credentials are a down and your outlook again is a thumbs up. So on an overall basis, you're looking at a rating of 5 out of the 8 parameters that NDTV Profit has looked at. But let's quickly address this with the management. We have Mr. Sushil Kumar Modi, Executive Director Finance at Lodha Group, joining in. Sushil, good morning and welcome to the show, and a pleasure as always to speak to you at NDTV Profit. On a year-on-year basis, a very strong set of numbers that have been reported by Lodha. I think what the street has taken negatively, at least at the beginning of the trading session today, is the sequential decline. If you could help our viewers understand as to what has led to the sequential decline and how big has the Indo-Pak war had in terms of execution, if you could quantify that for us.
Good morning, Mahima. Good morning. So nice to be there on the channel today to discuss the quarterly results and the performance. So, to your point, just to first understand our industry. In our industry, generally, the performance of the second half is significantly superior than the first half, as in our country, the festivities coincides across pan-India into the second half. And housing is being such a phenomenal asset class and a wealth that is being perceived. People end up in consummating their purchases more and more coinciding with those festivities. So to that extent, nothing different. In fact, this quarter is the best ever quarter in terms of the Q1 that we have registered, and pretty much on track to deliver 40 to 45% of our yearly guidance in first half, just like any other year, and the rest 55 to 60% to come into the second half. So there is nothing perhaps that is unusual that one would notice when you see the performance, be it the pre-sales, be it the collection or our business development. In any case, you would have picked up the business development side. We ended up in doing 22,700 crore, which is 90% of our yearly guidance in the very first quarter itself, which enables us to kind of enhance our launch pipeline further, which at the beginning of the financial year, we had indicated to be around 18,000 crore. But for the fact that we have ended up in doing such a large scale business development in Q1, the total launches for the year as a whole has got enhanced to 25,000 crore from 18,000 crore, of which 8,000 crore we have already launched in Q1, and the rest, another 17,000 crore, is to come in the next 9 months. So thereby the launch pipeline is very, very robust.
So Sushil, we'll talk about the launch pipeline, but my key question over here is, you did mention that the 2 weeks of uncertainty due to the India-Pakistan war did have an impact. Otherwise, you would have performed much better. If you can quantify that impact for us as to how much is that going to be? And secondly, will it have any impact on your full year FY26 guidance? Because the pre-sales growth, yes, it's 10% to around 4,450 crores, which is below the company's 20% full year guidance. So is there any possibility that the 21,000 crore target could potentially be missed because of this impact?
So you said right. So to the extent our business being so granular, wherein we look for our sales week on week basis, and in fact, our business perhaps amongst in the industry is one which is less and less to talk about the launches, but more and more to talk about the sustenance sale that we achieve week on week. Our sustenance sales up till last year was more like 250 odd crore on a weekly basis, which we have now enhanced and getting to the trajectory of more like achieving 300 crore. So if you see that, then to the extent we had some bit of a geopolitical tension within the country in last quarter that we are all aware of, automatically to say that the consumers' ability to move around or think about consummating their purchases has got depleted then in those 2 weeks. And to that extent, the sales of those 2 weeks did got impacted. So isn't it fair to say that perhaps we could have achieved another 3-4% higher sales, and thereby instead of growth of 10% potentially would have been more like 13-14% growth YOY? Yes, definitely it would have been possible, but nonetheless, knowing pretty well that the 9 months are still ahead of us and the launch pipeline being so strong, the interest rate trajectory having gone down significantly, as we know, RBI has reduced the interest rate by around 150 bips in last 6 months,
right?
And the income tax benefit also kicked in this year by the government.
Correct.
So all of those combined creates a phenomenal environment for a brand like us to deliver and capture the demand that is humongous sitting into the country. So
Right.
we remain absolutely confident of achieving 21,000 crore sales guidance that we have given for the year.
Okay. Mr. Modi, just want to get your sense on competition. Just give us a sense of what's the kind of market share right now that you garner in the MMR region, and considering the entire space of MMR region is heating up when it comes to competition, especially in the luxury and premium space, what's the outlook like? Do you see some threat when it comes to competition?
Frankly, we need to understand the industry a bit differently. The fact of the matter is this industry is going for a robust consolidation. The consumer, having burned their fingers big time in pre-COVID era, is no more buying from any tier 2 developers, and which is what has created a phenomenal opportunity for the tier 1 top-notch players to come in and take that market share and consolidate this industry, which obviously is healthy. So much so that pre-COVID, perhaps we were more talking about just touching double-digit number in terms of the consolidation, which has now, at the end of the last year has come to around 30% handle. So which is very healthy, and we are moving towards furthermore consolidating. So to that extent, some of the players, and in fact, that's a bit of a crisscross, right? The players from south or north coming to Mumbai, or Mumbai players going to beat south or or north, including us. We have gone, as you know, is into the south in Bangalore and doing phenomenal. In fact, we have now entered into the growth phase in Bangalore, where we are aiming for doubling our sales in the current year in Bangalore to achieve more than 2,000 crore perhaps. So to that extent, it is healthy. It kind of it takes away the market share and make the so-called tier 3 and tier 4 players out of the system, and creates a healthy pipeline, thereby the supply and demand all being sanitized. So that's healthy.
Okay. Sushil, my last question coming to you is your 2020 action plan by 2030. Are you on track for that? Because you're focusing to deliver around 20% pre-sales compounded growth and a ROE of 20% with net debt ceiling of 0.5 times debt to equity, which you're way below that right now. So that is one aspect. And the second question from my side to you is, in terms of the NCDs, auditors have put out a red flag that the security that is needed to cover the NCDs has not been enough this time around. What would you have to say on that?
So you have few questions. So to start with, in terms of end of the decade, our guidance of achieving 50,000 crore sales, which is nothing but achieving 20% CAGR growth year on year. And to that extent, we remain confident because we have set the stage for ourselves to be only looking for 20% growth, not higher than that, though the opportunity perhaps exists, and which also will come as a combination of potentially 5, 6, 7% from a price growth year on year, ensuring that the prices remains affordable and robust in the ecosystem, enabling the consummation of the purchases from the consumer side. That allows us to have only seeking more like 13 to 15% of a volume growth. And now entering into the Bangalore and potentially getting into the NCR in next year, that set the stage for ourselves to be so much so that margin of safety that we have created for us to deliver 50,000 crore sales is more like 40%, because taking into account our market share target, which is more like 20% for Mumbai, and any new city that we get in is more like 15%, we have an opportunity to actually deliver 70,000 crore of sales by the end of the decade. But we are only aiming for 50, which means we have the margin of safety of around 40%. So that kind of makes the business far more robust and granular. And as I said, our sustenance sales capability to deliver week on week ensures that we are in any case no more so much dependent on launches. If you look at overall environment where the interest rate trajectory in the country is so low, the inflation is all in control, that is the effective setup that this industry needs. And the fact that the home ownership in the country of an organized housing in any case is more like 22-25%. This is perfect set to kind of grow, with the economy growing anywhere around 6-7%.
So Sushil, all of that said and done, what about the auditor report which is stating the security cover available for debenture holders against the outstanding listed entities is not in line with the debenture trust deed? What would this mean, and where is the discrepancy?
Frankly speaking, that is our strength, right? Because we have got the AA rating from all the rating agencies, starting from CRISIL to ICRA to India rating, that suggests that now the lending ecosystem, be it banking ecosystem or a capital market, in fact, now NCD, when you talk, that means it is getting into the capital market, which we have commenced now to diversify our debt pool of capital that we want to be keeping, which in any case is very conservative. So that doesn't need that much amount of security, which in the erstwhile period, perhaps, a lending fraternity would have been looking or expecting from Lodha. So that's kind of is a strength of ours, and which is what you see in terms of our cost of fund, which has gone down by 40 bips in this quarter. In last 3 years, every quarter our cost of fund has continuously going down. In fact, our newer debt is now being raised below 8%, while the exiting cost of overall debt weighted average was more like 8.2. So that means you are going to further see continuously every quarter our cost of debt continuously going down. Just to kind of set few things right, because I saw you indicated our margins are going down. That's not the case. Our EBITDA margin adjusted with the interest, because in our P&L cost of goods sold, there is an interest element also because of the accounting issue that is there. If you strip that out, then actually our EBITDA margin for the quarter was around 34%, which is pretty much in the band of the 31 to 36 that you were mentioning.
Correct. So 31 to 36% is the band, and it's in line with that if you have to remove and change the accounting method. But thank you, Sushil, so much for joining us on the show and sharing the views, and that gives a clarification that in terms of the security cover for the NCDs, that's not an issue, and that's a positive that the management is looking at. But completely out of time, but that it's a wrap on this edition of Know Your Company. Please stay tuned to NDTV Profit for more.